मरघट तक है तेरी कहानी, पग पग प्यारे। दंगल 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 दंगल, सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे। दंगल 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 दंगल।
Great morning, my dear friends. Bhupeshanand this side, and today's lecture will be lecture number 2, and we will be putting the focus on the market value and the intrinsic value. That is my learning outcome number B. Market efficiency as a reading, equity as a subject, and learning outcome B, that is what is the meaning or the difference between market value and intrinsic value. A very important important concept and a highly testable area in CFL level 1 examination. So let's see what is the meaning or what is the difference between market value and intrinsic value. And before finding out the difference, we should be aware of what I mean by market value and what I mean by intrinsic value. So what I mean by market value, it means the value at which it is being purchased, it is being bought and sold. A security which is being bought and sold in the security market, that value, that price is named as market price or the market value. It means this calculator, this BA Tracking Plus Texas, this calculator has a market value, let it be 2000 rupees. It means you can purchase this calculator at the rate of $2000 from the market. But what is the intrinsic value of this? Supposedly this calculator has been touched by, this is being used earlier by US President Mr. Trump. I am assuming example. So the value of this calculator will not be now $2000, it will be something million in dollars, It means the value which is there, that true value, the justified value, the market value of all assets minus all liabilities, and the net figure which we calculate is named as intrinsic value. So there is a difference between intrinsic value and market value, or I can say there is a difference between price and value. What is the meaning of a price? The price is nothing but the intersection point of demand and supply, and we draw a line that is named as a price. That at this price we will purchase it or we will sell it. But the value is different. It can be more than price, it can be less than price. For a particular security, there can be different types of intrinsic values calculated by different valuers. So value is a subjective matter. Valuation is a subjective matter because it depends upon so many assumptions. For example, stock can be undervalued or overvalued. Stock can be calculated as per FIFO, which we have discussed in financial reporting. So on the basis of depreciation methods, on the basis of so many other assumptions, we can increase or decrease the value of an asset, and hence the value of intrinsic value will be different. But if I see the market value, that is different. So we in today's lecture we will be discussing about market value and intrinsic value. What is the meaning of market value? What is the meaning of intrinsic value? There's a difference between intrinsic value and the market value as per Google Baba. Intrinsic value is an estimate of the actual true value of the company. It is the actual true value. If actually we sell the assets and we actually pay the liabilities, how much will be the actual net worth, how much will be the one equity shareholder will be getting in his pocket. That is intrinsic value. And market value is the current value of the company as reflected by company's stock price. Now, what is the difference between this? We can see from the Investopedia that what is the difference between intrinsic value and market value, which I have just told you that there's a difference between intrinsic value and market value. And what are the ways, what are the models, what are the business models which we use for calculating intrinsic value? There is an inherent degree of difficulty in arriving complete intrinsic value because it depends from person to person. It depends from assumptions. It depends whether you are going for IFRS or US gaps. Due to all possible variable involved, such as value of company's intangible assets, because when we calculate the intrinsic value of an asset, we have to see how much is this intangible, how much is this IPR value, how much is this trademark value, how much is this patent value, and it is a subjective issue. It depends from person to person. So some persons use discounted cash flow, some other net liquidation basis. Market value. Market value of a company is value from its current stock and rarely reflect the actual current value of a company. The reason for this is the market value. It reflected by supply and demand. That where what is the supply of this security and what is the demand of that security, and where both intersect. We draw a perpendicular and we can calculate the price. That is named as market price. Now it is different from intrinsic value. You're getting my point. So please take out your registers. We will be very important point. We will be going to start with a very small learning outcome, very small lecture. We will be writing down some handwritten slides. A very small lecture is here. Lecture number 2, market efficiency. Learning outcome number B. I am doing learning outcome number B. Learning outcome number B. Distinguish between market value and intrinsic values. That what is the difference between market values and intrinsic values. Market value is the price at which stock is trading in the market. In the stock market, at which price stock is being traded, that is named as market value. And it is determined with the help of law which we have read in economics, law of demand and law of supply. Demand and supply factors, and demand of a security is being again affected by so many variables. Supply of a security is being affected by so many variables. So we are not concerned with that variable. The point is market value is determined with the help of demand and supply. Where those demand and supply intersect, we draw perpendicular, and that is the price, and that is named as market price, and that is named as market price. Please take on your registers. Hope you're writing these. These handwritten slides are very important. You should write down. In case you want to clear in first attempt, you have to write down. And this is a graph which I have prepared for you. Demand and supply, and demand is being affected by different variables. The note number 1 is very important. I am putting a star in this, 3 star in this. Demand is being affected by different variables. Demand is being affected by different variables. And the second point which I want to put emphasis is on intrinsic value, fundamental value, true value, justified value. These are all synonyms. We can say intrinsic value, we can say fundamental value, we can say justified value. It means how much is the actual value. So in that case, we calculate the market value of all assets, whether it is tangible, whether it is intangible. We will deduct the market value, the payable value of all outside liabilities and debt. And the balancing figure is net worth. We divide it with number of equity shares, number of stocks, after subtracting preferred stock, and the balancing figure which I will get, that is net worth for number of equity shares, we divide it by number of stocks, number of equity stocks, and that is named as intrinsic value. So please write down point number 2 in your registers. Intrinsic value is equal to fundamental value is equal to justified value is equal to true worth. Now intrinsic value can be calculated with the help of equity research report, or with the help of a model, financial model, or we can develop a financial model, business model, and on the basis of that we can calculate intrinsic value. But the point is, market price for a particular security is always 1. I repeat, a testable area. Market price for a particular security is always 1. But intrinsic value for a particular stock can be different for a different analyst, for a different valuer. It can be different. It is always different. However, analysis can have a different intrinsic value. An analyst can have a different intrinsic value. Analyst number 1 can have a value of 90. Analyst value number 2 can have an intrinsic value of $80. Intrinsic value for as per analyst 3 can be 82, and the market value is always 1. Now if I compare the market price with the intrinsic value, then I can find out that whether the security is undervalued or overvalued. Please write on this. Now for the same stock, if we compare the price, market price for the same stock, if we compare the market price with different intrinsic values, We can calculate whether the stock is undervalued or overvalued. Now, what happens in efficient market? A very testable area which I am going to tell you in point number 4, in point number 5, in point number 6, that what are the features of an efficient market. In case of an efficient market, all the securities will neither be undervalued nor will be overvalued, because all information is fully, quickly and rationally being absorbed in the prices of the securities. You're getting a point? So in efficient capital market, the best feature is, that all the securities are fairly priced, correctly priced, neither undervalued nor overvalued. Also, expected return is equal to required return. Now, what is the meaning of expected return and required return? I will be telling you. Firstly, please write on this third point. In efficient market, market value of a security is equal to intrinsic value of a security. And when I say market value is equal to intrinsic value, there is neither undervaluation nor overvaluation. So also, please write down also, it means efficient market has two features. This is feature number 1 and this is feature number 2. First feature is intrinsic value is equal to market value, and second feature is expected return is equal to required rate of return. As the name indicates, required. At least I require this much return if I am taking this much level of risk. That is named as required return. Now, required return we did in CAPM, capital asset pricing model, at the time of portfolio management. That if an investor is incurring this much level of beta systematic risk, and this is a risk-free rate, and this is the market risk premium, then this investor should have earned this much amount of return. That should have earned is named as required rate of return. You're getting my point? Please write down this. Firstly, write down required return, because I am explaining for required. Leave the space. Divide your page in two parts. One is below expected return and second is below required return. Firstly, write down for required return what should be returned at a given level of beta. Now we can calculate with the help of a CAPM model, that is risk-free rate plus beta into equity risk premium. Now, what is risk-free rate? The rate of treasury bonds, the rate of bank rate, that is risk-free rate plus beta, that is systematic risk. I have already told you covariance of market and security upon variance of market, which we have discussed in detail in portfolio management. So, supposedly I am assuming that risk-free rate is 10% and beta is 2 and risk premium as 5. It means 20% is the minimum rate which should this investor get. Now this is named as required rate of return. Required rate of return is the minimum rate, but the actual return is different. Expected return is different. It is forecasted return. It is on the basis of financial models that what you are expecting. So actual return is different. Just see to it. Firstly, complete for required return. From investor's perspective, required rate of return is the minimum rate of return. From investor's perspective, required rate of return is the minimum rate of return which a investor should get. Now, firstly, complete this left hand side of expected return. Expected return means that what you are expecting. What are you expecting as per the business models? This should be at least you should get 50% in CFL level 1 examination if you are putting this much level of hours, 500 hours of hard work. But what you are expecting, that can be more than 50%, because you know that you have given the hard work, sincere hard work. So you are expecting 60%. So when I say 60%, it is expected, it is forecasted. And when I say that if you have spent this much hours, you should at least get that. That is required rate of return. Now, expected return is equal to required rate of return in efficient markets. So please complete it. It means that you are expecting to earn. It means you are expecting to earn from that security, on the basis of financial models. On the basis of financial models, you are expecting to earn. Now, expected return is also named as forecasted return. Expected return is also named as forecasted return. Forecasted return. Now the point is, in efficient markets, expected return is equal to required return. But if in case of inefficient markets, expected return will not be equal to required return. Now if expected return is more, it means you have actually got 60% and 50% is the required, or it means expected return is more than required return. It means you have undervalued yourself. It means in future your value will increase. Now it is undervalued. So just write down fourth point. If expected return is greater than required return, let it be like this: 15% and 10%. If required is 10 as per the beta and expected is 15, it implies security is undervalued, and hence an investor is expecting to earn more in future. And if expected return, if you are actually got 40% and your required return is 50%, it means there is a problem. It is a case of overvaluation, and in future the security will be giving you lesser return and the prices will going to decrease. So we generally have a short position in case of overvalued securities, and we have a long position in case of undervalued securities, which we have discussed already in somewhere. So just write in fifth point: if expected return is this much and required return is this much, it implies the security is overvalued, and we go for a short position because the prices in future will be going to decrease, and we take a short position in that. Hope you have enjoyed this lecture. So, my dear friends, we have completed learning outcome number B, as per which what is the meaning and the difference between intrinsic value and market value. Be happy, be jolly, be